All right, so let's talk about the basic differences between a strangle and an iron condor. We're going to use this IWM index for the example. You can do obviously a strangle on any underlining that has options associated with it. Doesn't mean you should do it on any, but you can technically. Right? I'm going to show you the differences using the IWM today, and this is an ETF, the Russell 2000 ETF. And so I'm going to go out to 44 days here, and we're going to start by going over the strangle. Okay?
Happy trading!
So when you are executing a strangle, the Dorian Way, we want to keep it no higher than a 15 delta, just like almost every other trade that we do. That's a standard trade. Okay? That's a standard trade. When you're doing a strangle, you're selling a naked call, right? Meaning uncovered call, and you're selling a naked put, which means a unprotected put. Okay. So in this case, we're selling them both at a 15 delta. And we're selling them both at a 15 delta. When you sell an individual naked call, you have risk theoretically, infinite risk theoretically, okay? But nothing is going to go up into perpetuity, at least not in time frames that you're going to be trading these things. But theoretically, that's the case, okay? When you're selling on the call side. On the put side, you have risk all the way to zero, okay? Because it could. This is going down on an option chain this way here, so it could go to zero. This index is not going to go to zero, but a stock could go to zero. Okay? When you are doing a strangle, it's going to, the deltas that you put it at is going to be your probability of success at expiration. Okay? And when I say expiration, I don't mean a minute before or a minute after. I mean literally the time of expiration. That is your probability. So if you're selling a put at the 15 delta and you're selling a call at the 15 delta, what you want to do is add those up when you're doing a strangle. You want to add them up, okay? And then that's going to equal 30. So you subtract that from 100, and basically your probability of success in this example is 70% probability of winning at least 1 cent, making something at expiration. Selling a naked call and a naked put simultaneously. It's a more advanced strategy, but you want to understand it because it's really a basic strategy. Right? It's really a basic strategy. The kind of the formulation of it is basic. But is it advanced like risk wise? I think so, right? But it's a really good trade. It could be an excellent strategy, but I just don't think it's for everyone, especially not in my opinion beginners. You have to understand how the risks associated with the strangle and how to adjust it if you're not using automatic stops based on credits. Right? So in this example, it was 190. Right now it's saying 189 because the markets are moving. Right? But that is how much you're receiving. And you can see right here it's saying max loss. Well, it's not giving you a number because theoretically you don't have a max loss on this because it could continue to go up, right? So it can't define what your max loss is going to be in the next 44 days because what if the IWM jumps up 1,000 points, right? It's not going to do that, but I'm trying to give you an example. But when you're doing these trades using regular T margin, which everyone gets when they initiate a margin account, right? It's three different types of margining or margin accounts. Span margin, which is options on futures or the futures world. You got regular T margin, which everyone gets when they open up just a basic margin account. Then you got portfolio margin, which people get if you have a bigger size account, depending on your broker's firm. You can get portfolio margin. Portfolio margin is similar to span margin, right? Meaning that you do not have to put up as much buying power when you do trades, right? So in this example here, you can see that the max loss is not defined, okay, on this strangle here. But the brokerage firm and your and the regulators, they're requiring you to the exchange, they're requiring you to put up 24 here. $2,400 basically. That's how much they're requiring you to put up to be able to do this strangle. That's what they deem the risk is at this time. Right? It doesn't mean it's going to be static. It's actually going to be dynamic, meaning it's going to change. So this risk can become more. So they will ask for more buying power, or it can become less, and they'll give you buying power back. Okay? So, but it's usually between depending on the stock, right? Depending on the stock you're trading, it's usually between all the complete max loss you have to put up, right? They're gonna require a significant amount to do it if they feel like that stock is risky, or it can be as low as I believe 20% that they will put up for you to have to put up in buying power if you're using just regular margin. Okay? Now, when you're doing a strangle, you're going to receive a credit, right? You're going to receive some capital for it. And that is the most you can make when you do the trade. If you held this to expiration, the most you can make on this trade is $190. Okay? It's $190. You guys know that we don't keep our standard is taking this off at 50% for anything that's not the ES, the NQ, or the RTY. So you would get out of this when you were up 50%. So, and I just round this and say $100 once you've made $100. TastyTrade is saying on this trade you got a 88 to 90% chance of hitting that 50%. Right? So it's important that you get out of things that could move quite a bit at 50%. This is an index, so you could technically hold this one to 75, and that's what we do with indexes a lot of times. All right, so let's break this down a little bit more. So this is the at the money line, right? This is the at the money line. So when you're doing a strangle, it's inherently neutral. It's inherently neutral trade, right? You might have it skewed to one direction. You might have it skewed to be more bullish strangle. You might have it skewed to be more bearish strangle, but it's still inherently neutral. You want it to stay in between the two short strikes, right? So if it goes too far down past the put strike, you do have risk all the way to zero, as we indicated before. So that's your loss zone. If it goes too much up past the call, you do have theoretically unlimited risk to the upside. That's your loss zone. Nothing is going to go unlimited, right? Especially within the time frame that we're in. Right? But if it stays in between those, this is your win zone, right? So you have in this example, you have a pretty decent size win zone, right? You have a decent size win zone, but you do not, once again, want to go down too much. You don't want to go up too much. All right, so let's now break down the iron condor. Okay, so an iron condor is literally doing a strangle, but adding wings, putting in a built-in stop loss. Okay, built-in stop loss. So let's just say this is 5 points. That's buying the put. So you're doing an iron condor is selling of a put spread and selling of a call spread simultaneously. The strangle is selling a naked put and selling a naked call simultaneously. Okay? So this is a 5-point wide iron condor. Right? Your probability is still the same, 70% chance of winning, right? Because we have the 15 delta on both sides. So you take that 15 plus 15 and you add it up, that equals 30. You subtract that from 100, then that's going to equal the 70. Okay. When you're doing a strangle and an iron condor, you have to add up the short leg delta on both sides, because you can lose on both sides. You can't lose on both sides at the same time, but you have risk to both directions. So you have to be able to figure your probability, you have to add up the short leg on the put side and add up the short leg on the call side, and then subtract that from 100. Okay? So in this example now, you still have a 70% chance of winning, but instead of getting $190 on the strangle on this iron condor, you're getting $88. Okay? You're getting $88. Your max loss, instead of not being defined, right? It can't be defined. It's defined now. Your max loss is 411. That's the most you can lose. Okay? The most you can lose. You still got about a 90% chance of winning 50% at expiration on this, right? And your buying power, the buying power is not dynamic anymore. It's static when you're using regular margin that we all get. Okay? It's static, meaning that it does not change. You're putting up your max potential loss into the buying power, into the escrow account. So you do not have dynamic risk anymore. You have static risk, and you already have accounted for it by putting the 413 into the escrow account, basically. Okay? So a graduation process is starting with an iron condor. You never have to graduate, by the way, right? I primarily do iron condors, even though I like strangles because it's easier to adjust. But I like the buying power situation associated with iron condors better. Doesn't mean that you will like it better. Okay? Now, the iron condor has the buying power is defined, right? Like I said, and it's not dynamic like the strangle. So, but if we go here and we look at this curve view, you can see that this looks very, very similar, right? Right? You have that win zone. You have that win zone. The win zone is still the same. The probability is basically still the same. Okay? This is your win zone. But if it goes down too much now, you don't have risk all the way to zero anymore, right? You don't have risk all the way to zero. You scratch that out. Your risk stops at the put that you bought. So you got a built-in stop loss here from the put that you bought. And if it goes up too much, you don't have theoretically unlimited risk to the upside anymore. It's defined by the call that you bought here. Right? You have that built-in stop loss on the call side as well. So the most you can lose, in this example, we did a 5-point wide on both sides. So the most you can lose is if it goes down too much or if it goes up way too much is 413. That's the buying power that you put into the escrow account. You cannot lose more than that. You cannot lose more than that, and you cannot win more than what you receive. So anyway, this is the iron condor, and you can see how the iron condor and the strangle are both inherently neutral. You can skew to one side on either type of strategy, but the strangle has theoretically more risks on both sides. Not theoretically, it does have more, max loss risks, right? But your probabilities are the same, and you can argue that the probabilities on the strangle are actually more if you're doing the same trade because you're collecting more on the strangle. Okay, so the probability is a little bit better. But when you take, I like to simplify things and just take the delta and say, okay, 15 and 15 is 30 minus it from 100 to 70%. So I like to say that these two have the same probability of success. Okay, so any questions on the strangle versus the iron condor?